In this week's market update, stocks hit new highs as investors mark 10 years since the financial crisis began, and the dollar remains in focus as strong employment fails to stoke inflation. 10 years on, and the financial crisis continues to cast a long shadow. This is the week a decade ago in August 2007 when the world finally woke up to the fact that something was badly wrong with the global financial system. Pinpointing when the crisis actually began is impossible, but if any date can stake a claim to that, it's probably the 9th of August. That was the day when BNP Paribas froze 3 of its funds because it said it was unable to value the complex mortgage-backed securities they held. This was the moment when the rest of us started to catch up with the capital market nerds who'd been warning since the spring of 2007 about the health of the US housing market and the financial system that was propping it up. Specifically, they had worried about the impact a decline in US house prices, which optimists said could never happen, would have on a range of complex derivative products that few people really understood. Essentially, these were bundles of low-grade loans, corporate loans and mortgages taken out by people with poor credit histories and a high propensity to default. The loans themselves were poor quality, but thanks to a kind of financial alchemy, investment banks had packaged them up in ways that persuaded investors that they were really rock-solid investments. Collateralized loan obligations, or CLOs, collateralized mortgage obligations and other variants on these were single securities which bundled up a package of underlying loans and then sold them on to investors in tranches. The tranche that you bought determined where you were in the pecking order for returns as the underlying loan payments were made. So the highest tranches held the best quality loans and were less likely to default, and so they were paid a lower interest rate. The lowest tranches were risky, but they offered a higher rate of return. Slicing and dicing the loans in this way made it possible to pretend that the banks had turned metaphorical base metal into gold. For the tranches that got paid out first, even a set of bad loans could look like a reliable investment, and the ratings agencies consequently gave them their seal of approval. It was a nonsense, of course, built on very shaky foundations, but it was a nonsense that would only become apparent in the year following the closure of those BNP Paribas funds, as one by one the dominoes fell in a now familiar sequence. Queues outside Northern Rock, the collapse of Bear Stearns, and then, in the autumn of 2008, the big one, the implosion of Lehman Brothers. The rest is history. The freezing up of the financial system, recession, the slashing of interest rates to zero, the launch of massive bond buying programs under the banner of quantitative easing, and the vast inequalities all of this caused between those who were lucky enough to already own financial assets like shares and property and those who did not. Now, expect to read a lot about the financial crisis this summer and over the next year because the media loves an anniversary. But the reality is that the crisis started a long time before August 2007, and the reality is that it remains unresolved today, 10 years later. Debts remain high, and markets have returned to lofty valuations. It's been an unloved bull market all the way up, but the siren voices warning of another 2008-style crash are getting louder. The lower for longer interest rate environment that we live in today is the most visible and obvious consequence of the financial crisis. And once again, it's been in focus this week as the Bank of England unveiled its quarterly Super Thursday cocktail of growth and inflation forecasts and its latest interest rate decision. As expected, the bank sat on its hands, leaving interest rates at a 300-year low of 0.25%. Also, as expected, it tweaked lower its estimate of growth for the UK economy, both this year and next, and it nudged higher its forecast for inflation this year. Mark Carney, the Governor of the Bank of England, continues to err on the side of caution. He believes that the ongoing and so far completely inconclusive Brexit negotiations represent a significant headwind for the British economy. Having been opposed in this view by 3 members of the bank's Monetary Policy Committee in June, the vote was a more decisive 6-2 for the status quo at the latest meeting. Now this week, attention will shift to inflation in the US, with producer and consumer prices data both due to be released on Thursday and Friday. As in Britain, the absence of any serious inflation concerns is pushing the US central bank, the Federal Reserve, into a slower and lower trajectory for interest rates than many had expected. Although interest rates have risen by 3 quarter-point increments since last December, the mood music out of the Fed more recently has been altogether more measured. Some of the observers think the tightening in US policy may actually be coming to an end. If so, that would mark a significant change from earlier expectations that rates would continue rising in America until they reached a new normal of around 3%. The impact of this change of view has been dramatic. The dollar, which had risen at the end of last year in anticipation of US rates rising faster than in the rest of the world, has run out of steam. It's fallen by around 10% this year in trade-weighted terms. Now, as in Britain, where a weak pound has boosted the earnings outlook for exporters and overseas earners, the weakness in the dollar is not all bad news. It's been one of the principal drivers of yet more all-time highs for the main US stock market indices. The Dow Jones Industrials average recently broke through 22,000 for the first time, and the S&P 500 is close to its all-time high. So 8 years into a bull market, many investors are becoming increasingly nervous about the stock market's apparently endless upward path. But in a sense, it's supremely logical. Profit margins have risen to high levels and stayed there thanks to reducing costs, rising monopoly power for a handful of companies like Amazon and Google, and persistently low wage pressures. Indeed, the most recent earnings season has been very strong, with about 85% of S&P 500 companies having announced their second quarter numbers. Earnings growth is standing at about 10% year on year. It's the second quarter in a row of double-digit earnings gains, and it represents a resumption of growth after 5 quarters of declining earnings. At the same time, price earnings multiples have risen on the back of low inflation. Inflation, of course, the traditional enemy of bull markets. Today's world is a Goldilocks scenario of high profitability and low inflation. The key question is how long it can last. There are few clouds on the horizon right now, but just as there were in 2000 when the technology bubble inflated, and in 2007 when the credit bubble was expanding. The time to be most worried in investment is when no one is worried. It's interesting in this context that Alan Greenspan, the former Federal Reserve Chairman, has chosen this moment to warn not on the equity market but on the bond market. He said last week that the bond market is on the cusp of a collapse that will also threaten share prices, warning that the period of abnormally low interest rates that has supported bond prices is about to end. The challenge for investors is that Greenspan's timing has not always been helpful. Back in 1996, he said something rather similar about the stock market. He warned then that investors were demonstrating irrational exuberance. He was right, but he was way too early. The stock market continued to rise for another 4 years, and anyone who took fright at his words lived to regret it. In that context, it's perhaps unsurprising that the first half of 2017 was a record-breaking period for fund inflows in the UK, according to the Investment Association. Retail investors put £18.4 billion into UK authorised funds, and funds under management increased by £58 billion to £1.1 trillion. Mixed asset funds were the most popular, followed by fixed income. Absolute return funds were also popular, with the only real black spot being UK-focused funds as investors fretted about Brexit.